This week, the Fed disappointed markets. Hi everyone, welcome to the Trader Circle Weekly Market Update. Today is Tuesday, the 26th of September, 2023, and before I get into it, you do need to be aware that anything I say is general advice only, so it doesn't consider your personal financial circumstances, and you have to decide if it's appropriate for you. The big news this week is the Federal Reserve. We've got this lovely picture of Jerome Powell here, and by now you're no doubt tired of hearing me talk about it each and every week, but it really has been a very macro-driven market, very monetary policy-driven market, and the market's really sort of waited on every word from the Fed that comes out. So we saw the September meeting last Wednesday, and they did keep rates on hold as expected, but a bit unexpected was the fact that they still forecasted, at least according to their dot plots, one more rate rise this tightening cycle. Now, markets had been rallying for sort of the last, let's say, 6-7 months, maybe a little bit longer, on the belief that interest rates were peaking. So with their dot plot forecasting one more rate rise, it really did send a bit of a nervous streak through markets. And we saw US markets sell down, we saw the Australian market sell down, we saw markets around the world sell down after this. Now, it's quite understandable that they're forecasting another rate rise. We have seen inflation tick back up a little bit from the lows around July. And a lot of that is down to the oil price. You've obviously heard me talk about that as well over the past sort of several months. So oil's gone right back to sort of 10-month highs, roughly the peak of November last year, and that's forcing the price of many other goods and services back up as well. They also pushed out the potential rate cut timetable. So markets were hoping for rate cuts from the Fed in 2024. It looks like if we do get rate cuts in 2024, it's going to be towards the end of 2024 and possibly into 2025. So it really was a higher for longer with potentially another rate rise sort of update from the Federal Reserve. And that's really absolutely not what the market wanted, probably not what the market was expecting either. The market was expecting, that the Fed was going to say, oh, we're going to hold, we're going to keep holding, and, though we might hold for a while, we'll then, cut rates in 2024. So it was really a bit too hawkish for the market, a bit too negative for the market, and that really triggered quite a broad range of selling across just about every sort of equity market in the Western world. Not what the markets wanted, and what they got really sort of sent things lower. So one of the key things that we've looked at this week are the bond yields. Bond yields have pushed up very strongly after this, and that's basically as investors start to forecast, either more rate rises or higher for longer interest rates. Interestingly enough, Australian bond yields obviously have also gone up over this period, and they've broken higher. They've broken, the yield curve has broken its peak from October last year, and we've seen our bond yields go to sort of levels not seen since about 2013, 2014, after that sort of initial spike in yields coming out of the GFC. These are really, really high levels, not just sort of relative to recent history, but relative to sort of the last decade. Very high yields, and they're sort of putting a bit of putting investors on edge, I should say. Are we going to see a big sort of credit-driven crash? Are we going to see increases in defaults, increases in bad and doubtful debts, mortgage stress, things like that? And those bond yields pushing up is again very, very negative for share markets. So with our bond yields breaking higher, we've seen our market break lower, our stock market, and at the moment it doesn't look like there's a silver lining or a light at the end of the tunnel. Bond yields are right at their highs still. Our share market might have bounced a little bit off its lows, but it's not looking like it's just going to rocket back up either. One of the key things for the Australian market is Australian inflation, and we will get an update on this tomorrow at about 11:30 a.m. Australian Eastern Standard Time. That's going to be the August inflation data, and obviously, CPI is still extremely strong, still almost, double the target rate of the RBA here in Australia, and tomorrow it's expected to come in, still very strong as well. There was a bit of optimism around the middle of the year that inflation was coming down strongly, that we'd be back in target range, by the end of this year. And again, it doesn't look like that's going to be the case. Like I said previously, we've seen oil prices push up We've seen wages push up a bit. We've seen a lot of factors that have driven the cost of goods and services up a bit, and unfortunately it doesn't look like abating just yet. So as one commentator put it, we're paying too much for groceries. Well, the solution will be, we're going to pay more for our houses and things like that. So Australian CPI tomorrow, still expected to come in strong, and that could eventually force further interest rate rises. So the one thing I would just sort of say with this inflation reading is if it does come in slightly lower than expected, that could be a little bit of a bullish catalyst. That could provide a bit of relief to Australian shares. So we do want to be watching this reading quite closely, but it's not a guarantee. Obviously, I'm not convinced at all that it's going to come in lower than expected. I think it's still going to be another quite strong reading. And that could be, again, another negative sort of element that forces prices down a bit further as well. So following this CPI reading tomorrow, we will see US GDP data. That's going to be on Thursday night. And US GDP is still expected to come in quite strong. They're expected to grow over 2% for the quarter, and it's really not the economic slowdown that policymakers will want to see. So if you're a policymaker, if you're a Federal Reserve member, if you're an RBA board member, you actually do want to see the economy slowing down. You probably want to see unemployment tick up a little bit, and that'll be an indication that the interest rate rises are working. And that's not really what we're seeing with the data just yet. It's a terrible thing for people to lose their jobs or for the economy to really slow down. It's not a good thing at all. But unfortunately, that's the only mechanism by which these central bankers have to bring prices back down. And so they're going to hope that that mechanism is showing signs of life, showing signs that it's working. And as I sort of just said, unfortunately, it doesn't look like it's working, at least not very well just yet. So guys, I will touch on the charts very, very briefly as well. So let's just have a quick look at the recent selling that we've seen. This is the US S&P 500 index, the largest index over there by market cap, by variety. It's 500 of their largest listed stocks. And really it's been rallying since October last year. If you actually have a look at the October trough, that was their previous peak in bond yields, funnily enough. So if bond yields pushing back up, we do want to sort of be aware of what it did last time bond yields rocketed higher, and that was really sort of fall right off. Since that peak in bond yields, though, as bond yields came back down, their market really did push up, almost for sort of 12 months straight now. It peaked out in sort of July, and since then it's been coming off a little bit. There were early technical signs of a bit of a break lower, and that was, basically a lower peak, and maybe a lower trough as well. But really it was the Federal Reserve that sent things lower with their meeting on Wednesday last week. That caused them to break away from that sort of 44.50 level and back to the recent lows around 43.30. I think there's a fair chance these levels actually break again, and we see a move back towards maybe the longer term trend line at say 42.50 here, which may also be a bit of a support level given that it was a gap level in June. So I'd be looking for a move in the US on the S&P 500 to about 42.50, and if that breaks, 4200. Like I said, they are maybe just clinging on to the last little bit of support around here, but really I think they did dip below it on Friday, and I think the momentum is enough probably to drag them below this level. Looking at our own market, we're also looking fairly negative. We've come off quite a bit so far in the last couple of weeks. We broke through the 7100 level. We actually tested 7,000 on Friday, but we pushed back above it. And then today we're drifting back off as well. So if the US does go below their current support levels, I suspect we'll see 7,000 pretty quickly. And I think there's even a chance we come back to about 6,900, which was our trough in March. And that was after the US bank collapses at that time. Overall, the technicals are still looking very negative. We're setting lower peaks, lower troughs. Maybe, again, showing signs of tentatively holding support over the last couple of days. But, no sell-off happens all at once. It could just be a bit of a breather before we go for round two. I don't want to see that. I do want to see us bounce back from here. But at the moment, I think we're going to need some sort of bullish catalyst that'll trigger some relief in share price movements. That might come tomorrow with the CPI data for Australia for August. But I suspect it might take a bit longer than that. I think we're probably going to need to see some economic data showing a slowdown in the economy, showing a bit of an uptick in unemployment, unfortunately, and that might eventually trigger prices to sort of slow a bit. Alright guys, that's it for this week. Things aren't looking that great, but hopefully we will see some sort of positive news or positive things to report on at the very least in the coming months. And yeah, hopefully you'll be watching me in that video as I deliver the positive news. But regardless, if you enjoyed this one, let us know down below. Click the like button, click subscribe. We'll see you next time.